Okay, welcome back everyone. So we are busy with question 4.3. So we're going to continue with that question. So let's quickly just go back. So we finished in the first session, we finished the post-adjustment trial balance, which we took the pre-adjustment trial balance here and adjusted it for the entries that was listed on the right-hand side. Based on that post-adjustment trial balance, we have now drafted the statement of financial position, and now we will, and the notes relating to those specifically. So now we will look at the statement of profit and loss and other comprehensive income, which is basically showing all your income and expenses for the year to work out your profit or loss for that period, and then the statement of changes in equity, which will just show you the movement in your capital account. So if we go back to the Excel file, first thing you would have to do is you would have to list the information when you get a question like this. So you start with the general framework, which is your revenue less the cost of sales will give you a gross profit. Then we would generally add other income, and you would leave a gap for that to get to the gross income amount. Now that framework you can find on page in your textbooks. Let me just see what page has a good example. Okay, remember this one is for perpetual inventory systems, so you also get a different one which is for your periodic one, but for now you could just use the one for the perpetual one. So a good example is on page 128, would give you an example of the framework. So that is just something you will have to study, and then as you do it in the test, you would just record all the information. And then you say less distribution, administrative, and selling expenses, then you would leave a gap to just fill in all the normal expenses and adjustment entries that you have. And then based on that, you work out your profit and loss before your finance cost. Now, finance cost is interest expenses, and then you deduct the interest expenses to work out the total comprehensive income or loss for the year. Okay, now what we are doing here is we first working out the gross profit, then we're working out our gross income based on that, and then we work out our net profit. Now, the revenue amount, based on the information they've provided to you, we've got a sales account and a sales return account. Now remember, when we disclose this, we show the net revenue, the net sales. So we have to account for the net amount by taking the sales account less the sales return to get to the net sales value of 600,000. Okay, so that's very important. The revenue line item is the net amount. Then our cost of sales, if we go to cost of sales, the new cost of sales is 488,370, and we just transfer that straight into our cost of sales account here. And then our gross profit is the 600,000 less the 488. That gives us 111,630. Now the other types of income that we have based on our information is we've got rental income, interest on fixed deposits. So we've got rental income, which we then just transfer from there, which is the 24,000, which we get here. Interest on fixed deposits is 4,130, so that would be the interest income. But then we also had an account in here that we have any credit losses recovered. Okay, we did not have any credit losses recovered in this question. If you do have credit losses recovered, you will also include it at the top. Then you add all of these together to work out what is your other income amount. In this case, it's 28,130. And then if we add that to the gross profit, then we get 139,760. So that is our gross income. Then the expenses, we just transfer all of the amounts based on what's in here. So we've got telephone, The interest on mortgage we're going to show separate. We've got wages and salaries, repairs and maintenance, postage and storage, advertising, credit losses, depreciation, allowance for credit losses. So we are basically just transferring those amounts directly there from our trial balance to our calculation, and then we just sum them all together to work out what is the total expenses for the period. And then we take the gross income less that total expense to work out our profit or loss before finance cost. Then the interest expense we said is the interest on mortgage, which is the 59,000. We then deduct that as well. And then because it's also negative, a negative and a negative increases the negative balance to 89,000. So that is our total comprehensive loss. Because it's in brackets, it's negative. We've got a loss of 89,000. Now, the next step is taking this information as well as the capital information from your trial balance to work out your statement of changes in equity. So the first step for that is we want to know what is the balance of capital on your trial balance. So if we go here, the balance of capital is 469,770. There were no adjustments, so we know there were no additional contributions. So we know the balance is the opening balance because there weren't any changes. If there were any changes, like adjustments, you would first add the adjustment and then you will remove that amount from that to work out the opening balance. Then your loss or total for comprehensive loss is exactly the same as your statement here at the top. So you literally just transfer the value. Okay, let's just do that. We transfer the value from our statement of profit and loss and other comprehensive income straight into your statement of changes in equity. Now, in a test or exam, if you get this amount incorrect, just put your amount you've calculated in here. You get a method mark for transferring the information to the statement. And then the drawings amount we just get from our post-adjustment trial balance. Now, because it's a debit balance, remember, debit balances reduces our capital amount, which is a credit amount. So we deduct it, and then we add all of these together to get to an updated capital amount of 372,000. Okay, so that is how you do your statement of profit and loss and other comprehensive income in your statement of changes in equity. Do you guys have questions on the statement of profit and loss and other comprehensive income, or the statement of changes in equity? Are you guys okay with the disclosure that we've shown in here? Can you just indicate in the chat function if you're okay with what I've discussed? Because the next question, I'm going to get you to do it on your own. Okay, can you please indicate in the chat function, are you okay with the statement of profit and loss and other comprehensive income, how to disclose it, as well as the statement of changes in equity? You can either indicate an emoji or say yes or no, or if there's anything specific that you're wondering about, please let me know. Okay, guys, do you have any questions regarding the question we've talked about? Okay, can you guys hear me? Can you just indicate with a thumbs up? Can you actually hear me? Because I'm not getting any response. Okay, so then the next activity I want us to look at is question 4.4 in your textbooks. It is exactly the same principles of what we've discussed now. The only difference is instead of doing the post-adjustment trial balance, they actually ask you to journalize the adjustments. Now you guys do struggle with the journal, so we're going to focus on that, and then we'll finish the question in the next session. Just, oh, sorry. Let me open the Excel, no, the PDF. Okay, so if we look at question 4.4. Okay, similar to question 4.3, what they've done is they've provided you with a pre-adjustment trial balance. So that is your balances prior to taking in consideration any year-end adjustments. Now, in this scenario, you will see that the accumulated depreciation, they specifically show you that these are opening balances by telling you it's the 1st of March. If they don't clearly indicate it, you will have to be guided by the information, the additional information, whether the depreciation amount has been accounted for or not, to determine if the amount reflected is an opening or closing balance. So in this scenario, they showed you where it's a balance in the beginning of the year. That means no adjustment has been made. They also tell you the fixed deposit, what the percentage per annum is, which you will need to calculate the interest income that is generally accrued to the company. Okay, and then let's see if there's anything else that is specific that I need to note. Okay, so the rest of the information is just plain straightforward, your assets, your liabilities, income, expenses. Now, if we look at the additional information, this is the information that you will require for the first thing that you have to calculate. So to journalize the adjustments, this is based on the additional information. Okay, so we're going to focus on that in this for the rest of the session, as this is where a lot of you actually struggle. Now, those journals is then what you will use when you do the disclosures by updating your opening balances, which is here. So you will include these amounts in your disclosure, and then you would just add any adjustments based on this that you've completed in the journals. Okay, so let's quickly look what information do they give you, and then we'll discuss how do we actually account for this. So the first thing we say, the owner took trading inventory with a selling price of 1,600 Rand for their own use, and we use a markup of 33% on cost. The transaction has not been recorded. Okay, so who can tell me, based on that information, how will we account for it in the journals? What is the accounts that will be affected? One, and at what value will we remove it? Okay, so I'm just going to repeat the question. Based on the additional information, one, what general ledger account will be affected, and at what amount will we remove the transaction or record the transaction. Okay, so the first thing is say trade inventory. Okay, so are we going to debit or credit trade inventory? And what would be the other account? So remember, when we capture something, we will have a debit as well as a credit account. So there should be at least two accounts. Because of the fact that they said ignore VAT, we will not have the VAT account. So in this scenario, there would only be two accounts. Okay, so trade inventory, will we debit or credit the trade inventory if we take it out of the business? Okay, guys. So we will credit trade inventory. Okay, thank you. So what is the other side? What will we debit then? What account will we debit? What account will we debit if we credited trade inventory? If our owner takes something for their own personal use, to what account do we post that? Okay, so you're correct, it's part of owner's equity. Okay, so when we take something out of the business for personal use, we would debit drawings, which is the account for an owner taking stuff for personal use, and we would credit inventory. I'm just going to write you inventory. You can say inventory, trading inventory. It's the same thing. Okay, the value we will take it out of is we will take it out. So the adjustment will be at cost price. Now they've given you the selling price and the markup percentage. So that means you have to go calculate what the cost is for that inventory. Okay, so let's look at, okay, let me quickly just open the question. Okay, so what we have to do to do the calculation, we have to go look at what is the markup. Is the markup on cost or is the markup on okay, so is the markup on cost or is the markup on selling price? Now on this scenario, it said it's on cost. Now if something is on cost, we said that, which is fine. Okay, so if it's on cost, it means that the cost price is 100% or represents 100%. Our markup, which is your profit, in this case, is 33.33%. Okay, and that means our selling price would be 133.33%. Okay, which is the 100% plus the markup percentage. Now, if this 1,600 is represented by the 133%, to work it back to the cost, we divide it by that amount and multiply it with the cost amount. So the first journal entry would look as follows. You would debit the drawings. Okay, let me just make this a bit bigger so that you guys can see it. Okay, so the first thing is you would debit the drawings. Now we said when a owner takes something out of the business, they will take it out at cost price. Now we said cost price is represented by 100% and sales price is 133%. So that means we multiply it with the 100 and we divide it by the 133,33 to work out the amount. So the original cost of the value of the inventory that they took is 1,200. And we reduce the trading inventory because we've taken it out of the business. So our stock on hand is less. So we reduce it with the same amount. And then you have to give a narrative to explain what this journal relates to. So in this case, is the owner takes goods for own use. That is what we are capturing here. So that is the first transaction that we need to account for. Okay, so if we then go to the second transaction, we say according to the physical stock take, the following was on hand. So now we have to make adjustments, adjust inventory to reflect actuals. Okay, so this is what we are busy doing. But to know what the actuals are, we have to go look at what is the balances they have provided to us here at the top. Okay, so the first thing we see, the trading inventory based on the question is 44,700. But based on the additional information, it should be 42,400. So this should be 42,400. So that means I need to reduce that balance to that amount by writing off the difference. Now reducing the trading inventory amount, we take the difference to our cost of sales. Okay, so that's the first step. Okay, so if we do the first one, we account for the trading inventory. So we do the 44,000. Okay, wait, there's a transaction I'm missing, which is the 1,200. Okay. Okay, let's quickly see what other information they gave you. Stationery, consumables. Okay, so the first thing we have to look at, trading inventory. Oh, so we also remember, because point 1 was not accounted for as yet, we also have to adjust that amount at the top with the 1,200, which we only recorded in the transaction just before that. So to work out the movement, we take the amount that was given in the trial balance, which is the 44,700. Then we deduct the 1,200 from adjustment entry number 1 to get the updated balance, which is 43,500. And then we deduct the 42,400, which is the amount per the stock take. And then we only adjust for 1,100 to get to the correct balance. Okay, so you debit cost of sales and you credit your trading inventory to account for the deficit resulting in your physical stock take. So that is your description. Then if we look at the following items, we've got stationery of 600 and we've got consumable stores of 1,040 Rand. Now, if we look at the trial balance that they provided to us, we do not have those items on here. So we will have to go create a consumable stores on hand account. Now, we do not create one for stationery and other things separately. We add them all together as one account. So you would debit consumable goods on hand. You would add the 600 and the 1,400 together for the asset account. And then you would reduce the stationery account with 600 Rand and reduce the consumable stores expense account with 1,040 Rand. and we say this is the consumable stores on hand as per stock take. So what we are in essence doing is we are removing it from the expense account and placing it in an asset account to then only show the expense in the following year when we've actually used it. Okay, so this is the rationale behind this. Okay, before I move on to transaction number 3, do you guys have any questions so far? Are you guys okay so far? Do you have any questions before I move on to the following transaction? Can you just indicate if you're okay in the chat function, or if you've got a question on the first 2 accounting journals that I need to re-explain, please let me know. So I'm just going to repeat, do you guys have any questions on additional information 1 and 2 and their accounting entries or journals? Okay, can you guys just give me some emoji? Okay, so please, okay, so the last transaction relating to the consumable stores. Okay, so if we go back to the trial balance, let's quickly scroll back to the trial balance. So yeah, at the top of the trial balance, you will see we've only got trade inventory. If you go read through the rest of the accounts, there is no account for stationery, there is no account for consumable stores. So normally we account for stationery and any other consumables as an expense during the year. The reason for that is because you would generally use them quite quickly, so they don't have a long lifespan of use. So for that reason, we generally account for them as expenses rather than assets. But now at year end, you do a stock take. That is when we physically go into our stock rooms and we go count what is currently sitting on the shelves. And we then record that. Now, what this additional information means is when they did the stock count, there was 600 Rand worth of stationery still in our room, and there was 1,040 Rand consumables. Now, what the statement says is because of the fact that we haven't physically used them, we need to move that amount out of the expense account into an asset account so that in the following year, we then move it to the expense account, so to the correct year. So just apportioning it in the correct year of when we've actually used it, so that the financial information when we do the disclosure is accurate, more accurate. So for that reason, we create an account and we call it consumables on hand, which is made up of any type of consumable. So it's not only stationery, it's not only consumable stores, it's any small type of consumable that you would have used in a company but would have normally expensed. Now, based on this information, we had 600 Rand stationery as well as 1,040 Rand consumable stores. So when you do the entry, you create an asset account, which is your consumable goods on hand. That is the name of the account. And we include all types of consumables that we have on hand into that account. So that's why we've added the 600 and the 1,040 together. But because we're now reflecting it as an asset account, I need to go take out that amount out of the expense account because I haven't actually expensed it. I haven't used it. So we're reducing the expense to only reflect the actual amount of stationery or consumable stores that we have used during the year. And that is why we credit those expense accounts with that amount. And that is how the transaction is recorded. Does that make sense? Okay, let's then move on to transaction number 3. So transaction number 3, they tell you a debtor, Ms. F. Tumele, has been declared insolvent. Now, when a debtor is declared insolvent, it basically means they will not pay you. Now, what information we need to look for is we need to see how much money that they actually give us, so that we can determine how much money we need to write off. So they told you we received a check for 6,000 Rand, which constituted 30% in the Rand of her insolvent estate. So we got 6,000 Rand cash, and we have to write off the rest of the amount as irrecoverable. Okay, so now we know that 6,000 Rand was received, and 70% needs to be written off. But now the question is, how much does she actually owe? Let's see if we can see if they show you that information. Okay, so in here they show you debtors control account. Now debtors control account includes all of your debtors, not only just that debtor. Now, how will I work out, based on the information provided, how will I work out what amount I need to write off? Who can tell me? So I know I need to write off a portion as bad debt or credit losses. How will I actually work out what that amount is that needs to be written off? Who can tell me? Based on the information provided, how do you think you will work out what is the portion that needs to be written off? Okay, guys, if I tell you we've received 6,000 Rand, and that represents 30% of the balance, how will I work out what is the portion I need to write off from the balance? Okay, guys, how do you think we work out what portion we need to write off based on the information provided? Okay, do you guys know? If you don't know, please just tell me in the chat function that you don't know or you're unsure, just so that I know you guys are still live. Donovan, Nodia, Pomelo, Nokiano, Siwa Ukule. What do you guys think? How do you think we work this out? Yes, that's correct. So you take the amount they've given to you, you multiply it with 100, divide by 30. So that shows you the total amount outstanding. Okay, so that's the balance that was outstanding, and then you deduct the 6,000 Rand, or alternatively, you could have taken it, multiply with 100, divide by 70 to get to the, no, 6,000 multiply with 70 because 70% would be remaining, divide by 30, which is represented by the 6,000, would have given you the same answer. Okay, so let's quickly see what the journal would look like. Okay, so if we look at the journals, because we are writing it off, you would first account for the bank, so the 6,000 you received. So that is straightforward. Then we have the credit losses. So that is the difference of the balance that would be remaining. So the easiest way to work this out, this is actually F, is to first go work out what is the outstanding balance. So the entire debtors balance for that debtor needs to be reduced. Okay, so this would go to debtors control, the debtors control account, and we would normally just indicate in brackets which debtor it relates to, that when you do the individual debtors account, you can go and adjust it. Okay, so we said the 6,000 represents 30%. So if we multiply it with 100 divided by 30, we will get the total balance. Now to work out the credit loss, you can either do 6,000 multiply with 70, so that's the portion we're going to write off, divide by the 30, or you could have done the 20,000, which is the total balance, less the 6,000 we've received, would also give you the 14,000. So you could have documented either of those two ways and you would have got to exactly the same answer. Okay, now the account we use is credit losses. And why do we use credit losses? Because that is the lingo they've used in this scenario. If they've given you bad debts, you would have used bad debts instead. So because of the fact that they've mentioned it's credit losses, you will use credit losses in your general journal as well. Okay, if we look at transaction number 4, we say adjust the allowance for credit losses with an amount of 5,200. Now, the allowance for credit losses is a negative asset account as well. That is what we're going to reduce our debtors control with. So we will increase that amount to 5,200, but then the adjustment amount goes to the adjustment for credit loss, the allowance for credit losses adjustment account, which is an income statement account, which you will have to create. So let's quickly see what is the allowance for credit losses currently. So the opening balance based on this is 5,400 here at the top, which this says on the 1st of March. It needs to be 5,200, which means it needs to decrease by 200 Rand. So I'm going to decrease the allowance for credit losses account with 200 Rand. So I'm going to debit it. And then I am going to credit the allowance for credit losses adjustment account with the same amount, 200 Rand, which means we're getting some income into our books, because we are reducing the amount that we think will be potentially bad in the future. Then point 5 is based on depreciation. Now that is Learning Unit 3's information. So here you will see they've listed 2 types of assets. We've got vehicles at 25% per annum on cost. So that is your straight line method. Okay, it's just straight line. But then they also tell you that a new vehicle was bought for 360,000. So you have to remove this from the total cost as the period was less than 12 months. Now, why do I say that? The reason I say that is Because of the fact that we had that asset for less than 12 months, we will apportion that depreciation, but only for that one. And the rest of the amount would be accounted for a full 12 months. So what does that mean? So this means this vehicle amount, the 680, includes the new asset that was purchased to the value of 360,000. So we need to exclude that when we want to work out the depreciation. You do the 360 separately, and then the remaining balance you would do for 12 months. So let's show you what that transaction would look like. So we would debit the depreciation, which is the expense. So you start with the 680, you deduct the 360, and you multiply that with 25%. Now, the reason we removed it from the total balance is because we said the other assets, we've used it for the full year, so we do not have to apportion it. And then the new asset, we've only had for a portion of the year, so we have to apportion it for the 9 months that we've used it. So we multiply it with 9 months, divide by 12, because this percentage reflects a full year. And then we credit the accumulated depreciation of the vehicle's amount with that same amount. Now, how do I know depreciation has not been accounted for? If we go back to what I said initially, if you look at the accumulated depreciation accounts here, the balance is on the 1st of March, which shows you depreciation has not been accounted for, as well as if you look here at the nominal account section, there is no depreciation account. So that's how you know it has not been reflected. Then the next thing is we've got furniture at 16.2% using the diminishing balance method. That means I have to use the carrying amount to work it out. And a new office desk of 8,400 was bought on the 1st of September, which means before I work it out, I have to exclude that 8,400 to work out the carrying amount for the remaining assets that was there for the full year, and then the 8,400 would be dealt with separately because it wouldn't have had an accumulated depreciation amount. So you do the calculation similar to what you've done here at the top, except now you take the accumulated depreciation balance off, you multiply it with the percentage, and then the new asset, because it doesn't have any depreciation charge as yet, you would take that, multiply with the percentage, and then just apportion it for the period that you've used it. And then you take it to the accumulated depreciation, but the furniture account. So the specific asset it relates to, and you account for it as. Okay. Yes, who's got a question? Someone's mic was on. Do you have a question? Does anyone have a question based on what we've done on the depreciation? Any questions on the depreciation? Any questions so far? Okay, then if we look at the next transaction, we say a mortgage bond was registered on the 1st of March 24. Okay, now our year end is 28 of Feb 25. So that means it was registered in the beginning of the year. They tell you the initial interest was 12% per annum, and then was raised to 13% on the 1st of September. So that means for March, April, May, June, July, and August, that is 6 months, we would have paid 12%. and then 6 months 13%. Then they tell you that the loan is redeemable in quarterable installments. Okay, so we reduce the balance every quarter. Okay, so that also needs to be taken into account, and the first payment started on the 1st of June. And then they tell you all due installments were paid as scheduled on the 1st of June, 1st of September, 1st of December. And then we do a simple interest. That means we do not have to do compound interest, you just do the basic calculation. Okay, now for this one, to do the calculation, what I suggest you do is you do a little diagram like this. Okay, let's just So what I did is I showed each and every quarter. Then I showed where the percentages are. So the 12% starts in the beginning of the year, and then on the 1st of September, it changed to 13%. Now, I need to go work out what is the balance outstanding at the beginning of each period to work out the interest amount. Now, how I do that is if you go to the information they've provided to you. They told you the mortgage bond at 28 Feb is 856,000. Now, because they've already accounted for repayments, that is your closing balance. Okay. So because we've made the payment on the 1st of December, that 856 that is represented in our trial balance is the amount directly after the payment was made on the 1st of December. So then I take that amount and now I can work out what would the amounts have been directly after we've paid the amount on the 1st of September. So it's that 856 plus the 48,000 that we've paid would give us the 904, and you do this for all the transactions. Now what I do then is, because I know that for each quarter there was a specific percentage, we start with the first one. So we have the 100 at the 1 million that was at 12%, but it was only for 3 months. Okay, we'll give you 30,000. Then you've got the 952, also at 12% for 3 months. Then you've got the 904, but now we have 13%, which is at 3 months. And then the last one is the 856, also at 13% for 3 months. So that means our total interest that we are supposed to have paid on this account should be 115,760. Now let's go look at what they've given us. If we look at the interest on mortgage loan, we only have 106,000 in our account at that moment. So that means the difference between those two amounts still needs to be accrued for, and that would be an accrued expense. So that means when we do the transaction, we will have the increase on mortgage loan. So we worked out what it should be based on the calculation. We deduct what is currently in our trial balance. So we increase our interest on mortgage bond expense account, and then we create a liability, which is the accrued expense. Okay, so I see we are out of time for today. So what I want you guys to do is, for homework, go finish question 4.4 for me. I will discuss the rest of it in class to make sure that you understand what's happening, but I want you to go through the additional, I want you to do the additional entries 7, 8, and 9, and then I want you to start and try and do the financial statement of financial position, statement of profit and loss, statement of changes in equity, and the notes. I will just focus on the adjustment entries in class because that is where a lot of students struggle. What I want you to do is do the statements at home. We have covered how to do the statements in the first section, so you can do the other one on your own. If there's any questions, we can discuss it in class on Monday. And then I want you to also do question 4.5, which would also be very similar to what we've done. And then you can work, if you still have time, work through the comprehensive example for the periodic inventory system. That will show you how it is different from the perpetual that we were focusing on today. Okay, before we wrap up, do you guys have any questions?